We haven't seen a price decline that extreme, the 1.3, since the 08-09 period. That is a massive reversal.
Cathie Wood is CEO of ARK Invest and is aggressively banking on deflation. In today's highlight, Cathie will discuss rising inflation, unemployment, and most importantly, the unique similarities she sees between the 2008 housing crash and the housing crash we are witnessing today. Watch this video to prepare yourself for what's about to occur.
Now, on to economics. Again, I mentioned that the Fed is focused on lagging indicators, employment and inflation. So let's deal with those directly. Today was Employment Friday, and we knew that the number was going to be positive. It was more positive. Non-farm payroll was more positive than expected. Initial unemployment claims had been pointing in that direction as well. So non-farm payroll employment was up 261,000, better than the expectation of 190-ish thousand. Average hourly earnings were up 0.4%, a little stronger than the 0.3%. Now, of course, the Fed is railing against this. The Fed wants the unemployment rate, it seems, to be at 4.5%. We started to move up in terms of the unemployment rate. We went from 3.5 to 3.7, partly because the participation rate dropped a bit. So the Fed is getting its wish, I suppose. But you know what's interesting about this hypothesis? It's a Phillips curve, not hypothesis. I think it's been disproven. Phillips curve says, well, if you want to get inflation down, then you have to get activity down. The history of the 80s and 90s and even into the 2000s, if you look at it, is when real growth was strong, inflation was low. Why? Because of productivity. And I think that will continue to be the case. Nonetheless, that's what the Fed thinks. And so it's unfortunate, but we're probably going to see unemployment rising. And we're already getting some indicators. So here's the other side that the Fed isn't talking about that much. First, the Challenger Job Survey, it's a layoff survey, and it is showing a 48% increase in broad-based layoffs, meaning layoffs that companies are announcing that cut across divisions and involve quite a number of people. And we also saw that in the Purchasing Managers Index, again, leading indicator, that employment in that index went negative in this last month, October. Then, very importantly, in the employment report itself is buried a number called household employment. I don't know why they don't feature it more, the Fed in particular, because it's much broader based than a non-farm payroll survey, and it includes many more small and medium-sized businesses. It also includes people who are working 2 jobs or 3 jobs, and they'll just say that they're working. And it also includes what's called the birth and death rate of small businesses. And so that indicator, household employment, dropped 328,000. And if you look at it since March, it's been fluctuating, but since March, it's gone nowhere. Now, that's not the picture that non-farm payroll is painting here, but I trust this employment indicator much more than non-farm payroll because it's better at turning points in the market. So think about that. For more than half of a year, this measure of employment has gone nowhere. What we think has happened in terms of non-farm payroll, which is much more big company oriented, is that a lot of companies had so much trouble finding employees over the last 2 years that they're reluctant to let them go because economic indicators are suggesting they should let them go. If companies become mismanaged enough, then we probably will have more Twitter-like examples where a new and visionary leader goes in and cleans house. And today, I guess, Twitter announced 50% of its workforce will be laid off. So I do think that many companies are going to have to take strong action here because of what the Fed is doing. And the other lagging indicator the Fed is really focused on is inflation. Now, inflation, the downstream, closer to the consumer, is sticky, and it tends to be sticky at turning points. So we have the PPI still at 8.5% on a year-over-year basis, the CPI 8.2%, the personal consumption deflator 6.2%. 2%. But I'd like to share with you what's in the pipeline here. All right, so listen to this. Now I'm going to start with the highest price declines from their peaks, and these are as of October 31st when we did this report. So the Baltic Dry Freight Index, which really gives us a good sense of the rates, the shipping rates paid, they have dropped 74%. They peaked more than a year ago in October of 21, and they're down 74%. Lumber, May of 21 it peaked, it's down 73%. Iron ore, June of 21, it peaked, down 52%. DRAM prices, July of 21, down 51%. Silver, August of 2020, down 34%. Copper, March of this year, down 32%. Oil, March of this year, down 30%. Gold, August of 2020, down 21%. And corn, April of 22 this year, down 15%. Now, gold, interestingly, peaked more than 2 years ago and has broken down. It stayed in a 1,700 to nearly 2,100 range for 2 years, and it's broken down. Gold is a great leading indicator of inflation, and it was on an upward trajectory, which has now completely turned around. Now, a lot of these indicators are down on a year-over-year basis as well. Baltic freight down 58%, lumber down 22%, DRAM down 36%, copper down 23%, silver 20%, gold even down 8%. You've still got oil up 4% and corn up 22%. But you can see the pipeline is full of deflation. And as we know, with the inventories, and we look at them month to month, they're still increasing. Again, those ships are coming. I think last month, I described Nike's inventory on ships on their way over to the United States, up 85% year over year. And their North American inventory is up 68% as of the end of the August quarter. Importantly, the saving rate has come down to 3.1%, which is kind of shocking. Before COVID, it was at 8%. It went up to 34%, I believe, at the peak as the stimulus payments were working their way through. Now it's down to 3.1%. 3.1. And if you look at what the consumer is doing, consumers taking on more debt now. And so that what that is telling us, contrary to those who think everyone has a nice little cash buffer because of all the stimulus, we don't agree with that at all. A lot of people getting those stimulus payments were hand to mouth. As soon as they got it, they spent it either to pay down debt or to buy food or energy. Now they're taking on debt probably to pay for food and energy. That's not good. And consumer sentiment, again, near record lows where they were, where the University of Michigan sentiment was in the early 80s. Another very provocative number recently has been home prices. If you look at the S&P CoreLogic price index, it fell month to month 1.3% in September. It peaked on a month-to-month basis, meaning sequentially, at 2.5% earlier this year. That is a massive reversal, and the fastest reversal that I have seen on record. Even in 08, 09, the reversal kind of started in 06, 05, 06 or something. So housing prices are now starting to come down, and we haven't seen a price decline that extreme, the 1.3, since the 08, 09 period, when we were regularly at 2% declines per month. Now that the consumer will really feel as well, because again, the nest egg, home equity, is starting to come down.
Click this video to watch Frank Giustra reveal why we are headed towards a great monetary reset and how to secure your wealth during these times.